Welcome back to Carlton for Life. I'm a life insurance agent, but I'm not a salesperson. I'm actually horrible at sales. I hate trying to convince somebody to do something. I hate calling people a bunch of times to try to get them to do something. And I don't aspire to get good at that. I consider myself an educator. I educate my clients on how they can use life insurance to build wealth, and I let them take that information and make their decision. They'll call me when they're ready to take it to the next level. I created this channel, Carlton for Life, to teach everyone that finds the channel how to use life insurance to build wealth. Because when I was looking up this information, I found so much conflicting information online, so much misinformation, so many different ideas and facts. I lost my mind trying to figure it out. And it took me a long time to get to the bottom of what was important, what was fluff, and what didn't matter at all. Today, we're going to talk about the first step in your journey to building your own bank. And contrary to what most people may believe, it's not finding what type of policy you should be using, it's figuring out what type of life insurance company you should be using. So, like, subscribe, share, and let's get into it. Listen, anyone that's done any research online about the infinite banking concept or being your own bank has heard everything from people saying it's an absolute scam you should stay away from, or people saying it's the best financial strategy you should definitely be doing. I created this channel to give you the facts, to put you in position to make the best decision for yourself. Now, most people call this strategy being your own bank. I call it building your own bank because you have to build this bank brick by brick, premium payment by premium payment. And you have to do it the right way. So when people come to me, the first question they usually ask is which type of policy they should be using to build their own bank. And while that's a very important question, the first question they should be asking is which type of company should I be using? Because you don't want to build your bank with the right policy, but with the wrong company. There are two different types of life insurance companies, and I believe you should only be using one of them. By the end of this video, you should have the knowledge to understand which company you should be using. I'll let you know which company I use for my clients, and you can decide which one is best for you. Now, there are two different types of life insurance companies. You have a stock company and you have a mutual company. What are the differences? Let's start with ownership structure. A stock company is owned by its shareholders. What does that mean? It means that ownership is in the people that own the stock of the company. For example, MetLife is a life insurance company that's a stock company. Their ticker on the stock exchange is MET. If you go buy some shares of MetLife, then you are part owner of the MetLife company. Mutual companies are owned by their policy owners. What does that mean? It means that if you have a policy with a company like Guardian, then you are part owner of the company. That's how ownership structure works for both types of companies. Next difference, it's going to be the governance and decision making of the companies. Stock companies are governed by their shareholders and board of directors. What does that mean? It means that the board of directors and shareholders have say so in the decision making for the company. You have to be a shareholder or you have to be on the board of directors to make decisions for the MetLife life insurance company. For a mutual company, decision making and voter rights are retained by policy owners. Policy owners may have voting rights and make decisions for the company. Third difference is profit sharing. How do these companies share profits? A stock company shares profits in the form of a dividend to shareholders. What does that mean? If you own stock in a company like MetLife and they are profitable, then they will distribute profits in the form of a stock dividend. Mutual companies share profits in the form of a dividend to policy owners. What does that mean? If you own a policy with a company like Guardian and the company is profitable, then they share their profits in the form of a dividend given to policy owners. Next difference, primary focus. What are these two type of companies focused on? A stock company is focused on shareholder value. They want to make sure that shareholders are happy, and sometimes that makes them more aggressive for more growth. That's what they are focused on. A mutual company is focused on the policy owner. They're focused on making sure there are competitive premiums and making sure that policy owners have great benefits. That's what their primary focus is on. So, as you can see, stock companies and mutual companies have their differences. The question is, which company is better for building your own bank? I tell my clients without a doubt that if you're going to build your own bank, you want to use a mutual company. Why? For one, their primary focus is on the policy owner. As a policy owner, you are part owner of the company. They want to make sure you are happy. With a stock company, their primary focus is on the shareholder. I mean, let's pay attention to that. Stock companies want to make sure shareholders are happy. You can be a policy owner with a stock company, and their primary focus is not you. They want to make sure that the shareholders are happy, to make sure the shareholders are in a position to profit and take the company to the next level. So they have the potential to be more aggressive, for more aggressive growth, because shareholders want profits. Policy owners, on the other hand, in mutual companies, they want competitive premiums. They want benefits. They want to make sure that their policies are the best. When it comes to building a bank, I don't know about you, but I want the people running that company to be focused on my bank and not the shareholders that own stock in the company. Now, the decision is up to you. Which company do you think is best to build your own bank? Now, now that we have that down, right, which company we think we should be using, the next question is which type of policy we should be using. In our next video, that's what we're going to talk about. If you found this information to be useful, if you found that this information is something that can take you to the next level in your journey of figuring out whether or not you want to build your own bank, please like and subscribe to the channel. If you know someone that you think can benefit from this information, please share the channel.